All right, let us do a couple things. So, first, let's go ahead and review the exit ticket from last class and kind of get an overview of the things we've been learning. So, day one was intro into investing, day two was investing money 101, and day three is choosing investments, where we kind of deep dive into what are the different investment strategies that we could utilize. Okay, so that's what we're going to focus on. So, let's look at the exit ticket from day two and let's go over the results first. All right. So there were 6 questions. All 6 of these questions, there is a possibility that you will see all 6 of these on the test. So we want to make sure that we understand them and we just understand investing in general. A lot of times people don't invest because they don't get it or they're scared to ask. And so it's super, super important that you're not afraid to go talk to people or find resources out there. An example of this is I told you guys for my taxes, I love being an expert at things. I love being able to know things. I love being able to do things on my own. That's just kind of part of my nature, is to be able to learn how to do something. Well, unfortunately, the tax code in America is super duper confusing. And honestly, it's not worth my time. What is worth my time is to invest or pay a small fee for somebody else, a tax professional, to do my taxes, and or buying like TurboTax and walking through and doing my taxes. And it's usually always worth the little fee I have to give. So something to keep in mind is understanding that it's totally okay if you don't fully get something, but there's more times than not that you might need to go and you might need to go to somebody else to help you figure out how to do something. And that's totally fine. Okay, so looking at the exit ticket, true or false? Read each statement carefully, show whether the statement is true or false by T or F in the blank space. Number one, a stock market is a system where the public can buy or sell stock shares. True. We learned that last class. That's true. And we also learned that there are other stock markets all across the world, which is pretty cool. So keep that in mind that yes, this is where the public can buy or sell stock shares. Okay, number two, if you buy Snapchat stock, you share ownership in the company and you can vote on the types of updates that will be released. False. You do not have the right to vote on the updates that are happening in a company or the new products that are coming out. What you do have the right of is every share that you have that's a vote that you can vote for who ends up on the board of a company. So just kind of keep in mind that you don't have this, you can't just call the company and be like, I'm a stockholder, and because I'm a stockholder, I get to blah, blah, blah. No, it doesn't really work out that way. All right, number three, minors have to wait until they're adults before they can buy stocks and bonds. That is false. They are able to start buying stocks as a minor, but they set up a custodial account. And so that is false. Like, they can buy stocks and bonds. So if that's something you're interested in, you can start doing that. But your parent has to create a custodial account for you. And once you hit 18, they kind of are kicked off your account. So something to keep in mind. Now, a couple questions that again you might have asked or thought for yourself is like, Miss Markley, do you have stocks and bonds? I do have a couple bonds that somebody had purchased for me, my grandfather. I don't have stocks just yet, but this whole entire unit has got me into, starting in January, my goal and the reality is every month I'll put $200 in the stock market, whether that's a mutual fund, stocks, or bonds. Because I'm sick and tired of making excuses of not waiting, of like thinking I don't have enough money to do it when I do. All right, multiple choice. Read each item carefully, then select the best answer. Okay, 4. The time value of money can be best explained using which of the following concepts? Investment, increase in risk over time. Take time to pay yourself first. A dollar today is worth more than a dollar tomorrow. And compounding increases investment over time. Okay. When we're talking about the time value of money and what we learned last class, we're looking at C. Dollar today is worth more than a dollar tomorrow. We're looking at inflation in this category and knowing that if we were to purchase something today, it's going to be more money tomorrow. So by saving a dollar today, we know that that dollar is not going to get us as far as it got us the day before. Okay. Number 5. Kelly has money saved and invested several ways with a goal to grow her money at a rate higher than inflation. What is the historical long-term annual average rate of inflation? It is D, 3%. We know that on average, inflation goes up 3% per year. Okay. Label or describe at least 4 of the 5 elements of the TWTR stock quotient below. All right. So NYSE. So you need to have labeled 4 of the 5. I'm going to go over all 5 for us. You will see this question on your test. I promise you that. NYSE is the New York Stock Exchange, and it's the place that you sell or buy stocks. TWTR is the ticket symbol for a company. In this instance, we're looking at Twitter. So it's the ticker symbol for a company. Okay. Bid 64.90 is the current purchase price for one share people are willing to pay for. So you would write current purchase price for one share people are willing to pay for. Ask 65.19 is the current asking price in which the company is willing to sell for. And then 64.50 is the last price paid for one stock. Okay. So these are the answers for 1 through 6. All right. Last class we talked about inflation. And so a couple things that I want you to keep in mind about inflation is that, again, remember that historically 3% is the annual rate. So I'm going to look from last class information. And then also the time value of money, that $1 today is worth more than $1 tomorrow. So something to keep in mind, and seeing this nice little visual of $1 today is worth more than it was tomorrow. And then yesterday's dollar was worth more than today's. And we saw some of those numbers of inflation. Okay. So today you guys will be able to understand the different investment types. You're going to do a group activity. Even though I'm not there, I trust that you can get this done as a group. So please make sure we're understanding of that and what are the ways in which you can invest in their risks. Remember, our unit test is either on October 31st or November 1st, and there are 10 test questions from today's class. So we're either taking this on Halloween or Dia de los Muertos. All right, let's get some notes about risks and investment. So let's get some notes about risk and investment. Please pause this video if I am talking way too fast and you are not able to write. Okay, so let's look at Justin. Justin's investors. Now, an asset is an item of value that can be converted into cash. An asset can put money in your pocket. So that would be like a stock or a bond or a real estate that you can turn it into cash, and that can be money in your pocket. A liability is something you owe to another person. A liability takes money out of your pocket. Okay, so for example, if I purchase a car and I'm making payments on it, I am liable for that. It's a liability. If I do not pay it back, I have to give it up. Okay. A bondholder, someone who is owed a debt by a company. A bondholder must be paid before profits can be paid to shareholders. All right, so keeping that in mind, must be paid before profits can be paid to a shareholder. A shareholder is someone who owns a share or a stock in a company, a stockholder. The more shares you own, the more the company you own. Okay, so language of investing. There are 2 pieces that I want to go over. So there's rate of return, degree to which an asset gains or loses value over a given period of time. Basically, how much it's worth and how much you'll get paid. Example, Justin owes his brother 15% of his profit. If Justin makes $100 in profit, Derek will get $15. But if Justin makes $1,000, Derek will get $150. However, if Justin doesn't make a profit at all, Derek will get nothing. So something to keep in mind is when you're investing, you are putting in money hoping to make money, but also knowing you can end up losing zero. You can end up getting none of that money back, and you're kind of aware that that's the case. Risk is the uncertainty of achieving a desired result. Derek has no way of knowing whether he'll make a lot of money, a little money, or no money at all. And also understanding that the risk is like the time it could take. When you were looking at stocks, yesterday we looked at the Amazon stock. So let's go back here for one of your performances. And you might give money, and again, you might have no idea how much this company is going to do, or you might feel, so when this company came on the market, it was $173 a share. And so sometimes we don't understand what is going to happen over time. And so when we look over time, it's gone up. And maybe you would have pulled out in 2006, 38.94. I mean, you're significantly making a lot more money. But if you keep holding on, that company now has an increasing amount of shares, like increasingly amount. The price is insane. So it's something to keep in mind as you're looking into those sorts of things. All right, taking the risk. Basic rule of risk to return relationship. The higher the risk, the higher the return. Okay? So higher the risk, the higher the return. Your risk tolerance depends on when you need the money. Do you need it to be short term or long term? Your financial goals. Your ability to live with an investing decision with unpleasant consequences. Tame the risk. Be sure you can cover your necessary financial needs. So make sure you can pay your bills. You should not be investing unless you know you can be paying your bills, all of them, and on time. Know what you're getting into before you invest. Understand what could end up happening, okay? Making sure, like, all right, if you have $20,000 to put in the stock market, I know that's a big number, but say you have $20,000 to put in the stock market, you're not putting all of that into one specific thing that could lose you all $20,000. Guys, Memphis is being super cute right now, and he's kind of mad that I'm videoing and not looking at him. He's putting his little head on the computer, and he's about to make a noise. I can tell. I have to scratch his little chest. Okay, anyways. And invest in different types of investment. That is known as diversification, and we're going to talk about that. Diversify to tame the risk. Diversification, spreading your money among different savings and investments so that if one fails, you don't lose everything. That is so important. You might have heard of the phrase, don't put all your eggs in one basket. Spread out your eggs, okay? Invest in a combination of asset categories, more than one asset. Example, not all Facebook stock. Have different stock in different companies. A variety of assets, not all of them being CDs. A mix of investments within an asset category, so different industries. So maybe you do some that are retail, some that are electronics, some that are food-based. And different size companies, small, medium, and large, keeping in mind. Okay, so let's look at the power of diversification, but let's first look at the video notes. So power diversification video. One of the main benefits of investing in a fund rather than an individual stock and bonds is diversification, or the spreading of risk. Watch the short video through 219 to learn more and then answer the questions. What is it meant by asset allocation? Once you've done asset allocation, what's the next level of diversification you should do among each asset class? And how does diversification protect investors? So we're going to watch that.
Diversification might be one of the most used and misunderstood words in investing. In this video, we'll discuss what diversification is and how you can use it to build your portfolio. Diversification is the attempt to reduce risk by spreading your investments across a variety of different asset classes, like stocks, bonds, and cash. The idea is that with the right diversification, some of the investments in your portfolio will be going up while others are going down, giving you overall market returns and a smoother ride over the long term. In general, there are two main ways to diversify: diversifying by asset class and diversifying across investments. Most investors start by deciding how to allocate their assets among stocks, bonds, and cash. How you do this depends on your investment objective and time horizon. Generally speaking, the younger you are, the more equity such as stocks you should hold. As you approach retirement, you'll gradually shift toward more conservative investments like bonds and cash. One thing to note is that with interest rates at all-time lows, investors have been looking to alternative investments for higher returns and further diversification. Remember that the search for higher returns may mean greater risks and costs. Once you've decided on the big picture asset allocation, it's time to choose investments. You can further diversify the stock portion of your portfolio by purchasing individual stocks in a variety of market sectors, or by investing in a diversified basket of stocks through a mutual fund or exchange-traded fund. The same goes for bonds. E-Trade offers a full range of investment products across asset classes. If you work for a publicly traded company and hold a significant portion of your wealth in company stock, Diversification is especially important for you. You may experience significant losses if your company fails to perform. Diversification may help you mitigate that risk while maintaining the potential for long term growth. While diversification is important, you should not assume that it completely eliminates risk. It is simply the attempt to reduce risk by holding a basket of securities that behave differently in different market conditions. Also, diversification does not guarantee that if one investment goes down, another investment will go up. Risk is real, and diversification has its limits. Despite these limits, diversification is an effective strategy for long term investors. To start improving your portfolio, first, try our portfolio analyzer to find if your portfolio is diversified. Second, compare your current portfolio with a recommendation from our online advisor. And third, call an E-Trade investment professional for help if you need it. We're happy to help. Thanks for watching.
All right, go ahead and pause the video and answer the questions. Okay, so I wanted to show you an image. It's called the mixture of assets and defines the spectrum of return. So something to keep in mind is bonds tend to be safer, but they just don't have as high of a return. So the lower the risk, the lower the return. And then we know with stocks, the higher the risk, the higher the return. So stocks on average have the higher thing. So if we're looking at this, we're seeing what happens if we have 100% to bonds, all the way to red would be 100% to stocks. So kind of trying to see on average also what is the highest we could get in return, but what is the what could we end up getting, but then the average. So something to keep in mind is that maybe considering a 50-50 where you're seeing a decent amount of return. So 55.4% is the average. So we're kind of seeing where we're getting a little bit of everything. Where you're seeing the best and worst average returns for various stocks and bond allocations from 1926 to 2016. Memphis, stop it, buddy. So yeah, stocks, you could get a lot back, but keeping in mind that you could also see negative 43.1%. And there is still this chance that you're going to get a negative return on bonds as well. All right, so investment facts and questions. So things that you're probably thinking, how do I invest in this? Why would someone want to invest in this specific thing? What are the costs to invest in? What is the typical return range on this type of investment? And is this considered a low, medium, or high investment risk, and why? So we're going to focus on that today. So you have received this also in your notes. So you've also received this in your notes. Guys, Memphis is being super cute right now. So you are going to use pages 18 through 26 in this little workbook that is going to be given to you and left for you to complete the chart. Please make sure you only complete the investment assigned to you and your group, and you'll do a gallery walk to fill out the other information from our peers. If you cannot locate the information in the workbook, then you can use the internet. So use the workbook first. If you cannot find it, then use the internet. Okay, so I'm going to go ahead and type out your groups right here. I'm going to say them out loud. And you should already be in your groups because that was the sub in the sub notes. So group 1 is Kenya, Yair, Carlette, and Daniel. Group 2, Indra, Shabia, Karina, and Christian. Group 3, Morgan, Sohir, Mario, and Ernest. Group 4, Jeffrey, Stephen, Michael, and Faith. And group 5, Frida, Victor, Aisha, and Hassan. So at this point, you all are trying to figure that out for each specific thing. So bonds is going to be Kenya, Yair, Carlette, and Daniel. Mutual fund is going to be Indra, Shabia, Karina, and Christian. Real estate is going to be Morgan, Sohir, Mario, and Ernest. Collectibles is going to be Jeffrey, Stephen, Michael, and Faith. And then business is going to be Frida, Victor, Aisha, and Hassan. So you guys as a group are going to get this information, and then you are going to share that information with somebody else. So the way I would do it is I would then form totally different groups. So like group 1, group 2, group 3, group 4, group 5, you're all going to get your information. And then I would create one more group. So for example, I would do Kenya, Shabia, Morgan, Jeffrey, and Frida, you guys all get in a group and you all share your information from your specific groups. And then, so everyone would be in their first group, and then the second group is a mixture of somebody else from all the different groups. So that way you're able to get the information. Okay? So you're going to complete that. You can pause this video and you can press play when you're ready for the exit ticket. This should only take you about 15 minutes to complete, so please make sure you're utilizing your time wisely. Okay, your exit ticket. So do this at a voice level 0, work independently, and complete the exit ticket. Stay in your seat. There should be 100% effort, and you're going to see a lot of success with this. Make sure you answer questions 1 through 5, and we review next class.